You go to the gas pump, we were paying, $2.99 3 weeks ago here in New Jersey, and now $3.99, and that just means less money and available to spend on other things. And so it's almost mechanical in that sense, that deterioration in real spending.
Start with the base rate. And then
Yes.
if you have a strong conviction that they're going to do something other than the base rate, then you better be very, very good in making that assumption or calculation.
The press sadly is again one-sided and talking only about the bad and the worst case scenarios, this SaaS apocalypse, or I call it SaaS catastrophe, whatever. You have to differentiate.
You're looking for those kind of situations. You like winner-take-all markets as long as you have the winner.
Welcome to the Excess Returns Weekly Recap. I'm Jack Forehand, joined by Matt Zeigler. And Matt, anything going on in the market this week? I was kind of taking a nap. I wasn't sure.
I think it was pretty sleepy. I think if you were Rip Van Winklen over there, that's the way to play this one. No, I think a lot was going on. And so help you God if you even so much as looked at your Twitter feed next to your price quotes, because the comments are just flying from world leaders, from pontificators, from allocators. Like the actual divergence and the variance of like opinions, takes, and whatever else. This might be the most confusing thing that we've experienced, I feel like, since maybe the pandemic, probably the financial crisis.
And the cool thing is we've got the whole spectrum today. We're going to get into the now, which is this oil shock and how it impacts markets. We had an interview with Bob Elliott this week. We're also at an episode of the 100-Year Thinkers, which is basically as far from this as you could possibly get. Like, you did not talk about the oil shock at all with the 100-Year Thinkers because it doesn't impact people who are thinking that in that time frame. And then we also had Larry Swedroe on private credit, taking the other side of what some of our other guests have done. So we've got a really good balance. We got great clips. And you ready to go with this?
I'm ready to go with this. We're doing this and we're trying to pull these ideas out because this is, I can say this professionally as an allocator, this is the kind of stuff where being part of the conversation and playing them back, man, is this useful. So I'm really excited. Let's break this stuff down. Let's go.
So the first thing I always like to ask guests is we like to try to be as evergreen as possible. So the first thing I ask them, rather than analyze this current situation, is let's take this up a level and say, an oil shock in general, how does that impact the economy? How does that impact the market? All that stuff. And so that's where we started. So here's Bob Elliott talking about that.
Yeah, well, the first thing I start with is how do you think about an oil supply shock in general? The first thing to keep in mind is essentially there's very, very little demand destruction when it comes to oil. Like if you go back and look at the financial crisis, very minimal. I mean, that was like a terrible economic crisis, or the COVID crisis, very, very little demand destruction, which means that every time you take even a modest amount of oil off the market, you get relatively acute price moves. And so that's basically what we've seen. I mean, the old rule of thumb, and this, this is like what the grizzled oil trader will tell you is, take 1 million barrels off the market and you get about a $5 to $7 dollar move in oil, which is essentially what we've gotten, give or take. Like if you look at Brent, we've taken maybe 8-ish million barrels off and we've gotten a price move of $50. And, that's basically what you'd expect in the near term. And so I don't have a particularly strong view beyond that. Like seems largely in the ballpark of what you'd expect. I think the challenge then is now we've got oil, we've got oil inputs that then flows through in terms of the real economy to all sorts of different things. And one of the key things to keep in mind is it's not a one for one. So for instance, if you look at things like heating oil, jet fuel, and gasoline, traded gasoline, those prices have actually gone up more than oil prices have gone up, in part because refiners are taking a better margin on it. It's exactly what we saw in 2022. And so actually, if everyone focuses on WTI, it's actually a bit misleading in terms of what the pass-through effect is to the traded prices. Now, what the consumer then sees is not just the traded prices, but of course, taxes and issues and various things, delivery costs and things like that on top of it. And so you have to adjust for that as well. I think the overall, the sort of basic rule of thumb here is you typically are going to see something like 20 to 30 basis points of headline inflation increase for every 10% rise in oil prices, in that order of magnitude, right? And that's because that reflects sort of the direct pass-through effect of oil prices and products. But then, of course, like, my Fresh Direct guy now just added, a $2.99 surcharge on top of it for his delivery. So, that also flows through as well. And so that's sort of the overall economy effect. And so what oil prices are up 50 or 60% on WTI, depending on exactly what you're looking at. And so you'd see, 150 basis points, maybe 200 basis points of inflation pressures flow through the economy when we were starting at somewhere between 2.5 and 3. And so that's actually a pretty significant flow through, because not only is that a pretty meaningful rise in overall prices ahead, but that also means that is essentially the flip side of that is the immediate hit to real spending power for households, right? You go to the gas pump, we were paying, $2.99 3 weeks ago here in New Jersey, and now $3.99, and that just means less money available to spend on other things. And so it's almost mechanical in that sense, that deterioration in real spending.
So yeah, Matt, I love this. I love the idea of just thinking about like the different steps that happen in an oil shock. And I think the most important thing to realize is like oil is not a commodity that when the price goes up, the demand changes that much. And when you think about it that way, then you think about, all right, if people aren't going to buy less oil because it goes up, they got to buy less of something else. And that's why you think about that's why this is more of a serious economic impact than some other things would be if the price of them went up.
And the crazy part about here is we're not just talking about are North American people going to buy less ice cream cones this summer. This is a global phenomenon that we have to think about and think through the ramifications of, because consumption in different parts of the world is going to move in different ways in response to this crazy shock. There's not a lot of people who can help sort of like both zoom out and zoom in at the same time the way Bob can on these stats.
Yeah, and Bob has studied markets probably better than anyone. So when you think about just the steps of the process, like here's what happens first, here's what happens next, and he did a really good job of that in the clip. He's really good about just thinking about like here's what is likely to happen as we work our way down and as this impacts the market.
What about for you? How do you actually think about, when I'm listening to Bob in this episode, I'm thinking about the actual steps that happen. I feel really fortunate as a mostly work from home person who, outside of going to some baseball games, like I don't do a lot of like extensive car traveling. I'm going to get on a plane sometime soon for some work travel and some other stuff, but it's like the price of gas doesn't affect me as much as it did. I remember viscerally the feeling of like going and coming to work in the run up to the global financial crisis, when basically like the job and everything else was in peril and the price at the pump went bananas. And I remember the visceral pain of filling my tank and being like, oh my God, did like every week just go from like whatever it went to, like $25 up to like $70 or something like that to fill the tank, just to get back and forth to work every day. I'm thinking about this a lot lately. How does it impact you?
And this plays into what we've talked about before. Like we talked about when inflation came, we talked about the idea that everybody has a different rate of inflation. And it's kind of the same idea here. Like you and me are the last people to be affected by an oil shock because we're sitting in our houses all day, like on Zoom. Basically, like I fill up once every month, maybe at the most. So it doesn't impact me that much. But when you think about the rest of the economy, and Bob, one of the good points Bob made there is it's not just oil. Like it's diesel, it's all this other stuff. I mean, think about all the things that are made from oil. Like eventually, as it gets, I mean, you see the price at the pump right away. Like I don't know if you've been to the gas station recently, but I went and looked at the diesel price. Like the diesel price is off the charts. Like that reacted much quicker than the regular price did. So it's just one of those things that, like, if you can think about the price of anything going up, probably the worst thing economically to go up is probably the price of oil, because it affects everybody, and because people aren't going to buy less oil, so they're going to buy less things in the rest of their lives.
Yeah, that trickle out effect. Because I mean, even the electric or the mostly electric hybrid trucks that are doing Amazon delivery packages in my area, it's like, okay, well, there's still like the natural gas plant that powers the electric facility, that powers how we all plug in, and I get my electricity bill for running this camera and Zoom and whatever all the other crap that we're living our lives on. So it's the idea that you can even predict what the ramifications are of this spider web, and just to be aware that this is going to push decisions into all sorts of parts of our lives. That's really hard to predict. So it was really cool hearing Bob break this down.
So our next clip, as I mentioned before, we're going to pivot a little bit here, but This was a really interesting, I think you asked a really great first question in the 100-Year Thinkers episode. And it's this idea that, Chris Mayer did this study basically of 100 baggers. And people have taken that study, I think, in the wrong way in many ways. And so you asked Chris about the relationship between this study and base rates. And here's what he said.
No, it's not really a base rate study. It's a study of the extreme outcomes. So sometimes, every once in a while I hear somebody say, oh, it's survivorship bias. It's not survivorship bias because I'm not looking at the study and saying, how that these statistical profile or whatever is going to predict the next 100 bagger. I'm looking at the ones who've made it and, what we can learn from that as studying our businesses and what conditions maybe are not, sufficient alone, but which otherwise seem to be necessary. I sometimes use analogies from sports. It's like, if you wanted to study, if you were studying great golfers, let's say you were studying Tiger Woods' swing, you wouldn't say, oh, it's survivorship bias because you didn't look at all the people who swung like that and didn't make it. You wouldn't say that. You're looking at Tiger Woods. They're looking at a guy who has made it, who's very successful, and you're looking at traits and things that he has or other pros have in common that then you can apply and your own successes. It would be different if I looked at a whole population of people that swung like Tiger Woods, then that's when you start, we start thinking about survivorship bias. I don't know if that makes sense, but there is a difference between taking a statistical study and using it to make a prediction versus just studying certain extreme outcomes and, learning from what sort of traits you can pull out from that.
I wanted to start here because I wanted the anti-definition. So thank you for getting appropriately riled up by this. Parse, literally, I think this is so important to understand. Parse survivorship bias, base rates, and untangle those, why you reacted the way you did to my provocative question.
Me?
Yeah, you.
Yeah, I think I don't know if what I can say more than I already said in a way. I know because I've had people say that before and say well, it's survivorship bias, but I think they're misunderstanding the intent of the study. Because again, it's not that I am looking at all these, trying to come up with a profile that then we're going to apply to an existing population of companies and predict which ones are 100 baggers. So it's, I think also another way to think about it is markets are extremes, power laws prevail. And, it's interesting because Bessenbinder just updated his study a couple of days ago. I don't know if you all saw it, but, again, I think it shows you the extreme outcomes of markets. And that's for people who are interested in that or interested in looking at great businesses and seeing, what ones may have similar traits as these other extreme outliers. That's really the usefulness of the study. It's not meant to be a statistical analysis of predicting the next 100 bagger.
There's a magical thing where you hope you're going to ask. This is like the one time in like a million that I feel halfway like a journalist, where I'm like, I think I can say something that'll get under Chris's skin just enough. Chris isn't the type of guy who's going to yell at you or it's not going to turn gotcha journalism or something like that. But once in a while, you think you could just get a question that will provoke somebody. This one provoked Chris.
It was perfect. And he handled it really well. He handled it really calmly. But I think the idea is people on both ends of the spectrum misread that study. So on one hand, they're like, you know what? I am going to find the next 100 bagger. All I got to do is take the stuff he wrote about in the book and I'm going to find them all. And my portfolio is going to be full of 100 baggers. And on the other hand, it's this is just survivorship bias. Throw this stuff in the garbage. This is a complete waste of time. And both of those are completely wrong. And that's what he got at in the clip is the idea is not if you use these exact criteria, you're going to find the next 100 bagger. But the idea is it might help you in thinking about companies that did achieve this outcome, what they did. So both of those takes on both ends of the spectrum are wrong. And what Chris said is the way to look at something like that.
I think this is a tortured metaphor, but I think about this a lot. It's you really have to keep refining the area that you're looking in, the domain you're looking in, as you zero in more and more and more. And back to I think he used the Tiger Woods metaphor in this one too, where it's just studying Tiger Woods, if you want to study him as a reference of all golfers ever, that's going to tell you what an outlier he is. But if you actually study him, there's still lessons that you can learn, and it may or may not help you find the next Tiger Woods, but you'll start to see, and we get into this deeper into the interview, different base rates apply to different scenarios, and you can start to parse this stuff apart. I think a lot about if I want to get something that has like a toy in it, like I'm not going to get the healthy food. I'm not going to get the healthy cereal. I want the sugary children's cereal. I want the box of Cracker Jacks. Like you got to think in these domains and the subcategories of the domains for what you're looking for on the other end. And there's a lot of richness and nuance in that. Was there any other stuff on like the statistical side or just thinking of it that you're
Actually, this made me think of, do you remember Good to Great by Jim Collins?
Yes.
This made me think of that because you had a similar argument around that as well. And I kind of took it the same way. I guess like if you bought a portfolio of the companies mentioned in that book, it like the performance was horrible going
terrible.
forward or something,
Yep.
or like it all fell apart. But I still feel like when I read that book, I learned some things about like how businesses improve themselves. And so I don't feel like I care how the portfolio of stocks listed in the book did. I mean, it's very rare for any company to be like a company that's just perpetually good forever. I mean, if you think about like, I remember back in the day when I was growing up, like Jack Welch lived in the same town as me. And he was like the hero that saved GE. And it was the greatest example of all time. And then like it completely imploded, like the whole thing. So it's just like, I feel like with these things, you want to take, what can I learn? How can I apply it to what I'm doing? And not necessarily like, how did the portfolio of stocks do going forward? Or can I apply these exact rules to find the next 100 baggers? I think those are the wrong ways to interpret things like this.
The best lesson, I think, of Good to Great and of this stuff is it's that marginal change that you're trying to capture. Like the Good to Great thing, those companies might have gone from like great to amazing to dreadful. And that's going to happen sometimes. Even the 100 bagger is going to slow its eventual rate of growth at some point, is going to evolve into something else. You're just trying to capture it from when it moves from good to great. Or if you're a value investor, you know, from absolutely terrible to objectively awful. Like whatever your sweet spot is on that continuum is all you're looking for. And this is just another great reminder of know the place where you're trying to aim, look at that amount of change you're trying to get or trying to hone in on those characteristics, and have some type of methodology in your brain, even if it's as corny as get the right people on the bus, to borrow from, Jim Collins on the Good to Great stuff. Get these things in your brain because then they're useful heuristics for getting the part of the curve that you're actually after.
So I think we could say your sequel to the book, Amazing to Dreadful, is now will be available at bookstores around the country shortly.
I've thought of it a long time. My favorite one in the Good to Great literature is definitely the Doom Loop one, where he talks about the companies and how they fall apart. And I think in the Jim Collins oeuvre, like if there's a book that you can learn probably more than you can learn from Good to Great, it's the Doom Loop book, which kind of explains a lot of what happened to many of those companies.
And I would like that for the same reason. Like I'd like to understand the reasons they failed. And you know what? It might be that like if you bought a portfolio of those, it goes up after or something. But who cares? Like that's not the point. The point is I'm learning from success. I'm learning from failure. So I think that's the takeaway from all this stuff.
So speaking of learning from success and failure, can we talk about private credit? Can we go there next?
Yeah, I always like getting balanced takes on stuff. And, we've done the negative episodes on private credit. And I wanted to do an episode that just sort of looks at what's going on behind the scenes. And Larry Swedroe has been writing about this a ton on his Substack. He invests a lot of his own money in private credit, and he's looked at this a lot. So the first thing we talked about a lot of stuff, and I would highly recommend anybody listen to this episode if you want to understand what's going on with private credit. But one of the things we talked about in the episode was this idea that there's going to be mass redemptions in private credit. And that's going to cause all kinds of side effects. So here's Larry talking about that. Think about that.
This is really the most important issue in underwriting or doing your due diligence on a private credit firm. So let's talk about that. What the media fails to talk about is that there are several sources of liquidity. Okay. So the first line of defense, of course, is cash. And second could be public assets. So what some of the firms do is they'll go out and own public assets like BKLN and SRLN, but you're getting, let's call it 3% a year less for that on a risk-adjusted basis. On an unrisk-adjusted basis, it's higher than that because of the leverage in these vehicles. So you're giving up significant yield to keep that liquid. But if you own 15% of that and you got 5% cash, you got enough to meet a whole year's liquidity. So some firms do that, okay? Second thing that you have to understand is you can have bank lines of credit. Now, banks or private credit firms, some of them, and one of them was in the press, I don't recall the name, got in trouble because it didn't pay for a guaranteed line of liquidity. Well, we've got an agreement with the bank, but the bank could pull it. Cliffwater pays for, it's another reason why I use it, for guaranteed lines that go out multi-years, tranched over a number of years, so they got rolling and they keep rolling it forward, okay? And they've got, I think, 21% of the portfolio has got guaranteed lines of credit. So that's enough for a whole year in and of itself. But that reduces returns. But I think it's a much cheaper way and a better way than owning public assets with much lower returns. You don't have to give away 3% a year to get a guaranteed line of credit. Second thing most people don't understand, and I haven't seen any article write about it, private credit loans are typically made 5 to 7 years. But the average outstanding is about 3.5, because some of them prepay early because a new private equity firm takes over. They could take it public. There's an acquisition, lots of different reasons. Their credit quality improves, so they can renegotiate now, better terms, lower spreads. That gets redone. And the average maturity or average outstanding is about 3.5 years. Now, if you have a normal environment like that, that means about 1/7 of your portfolio, or 14%, 15%, is paying off every year. That's 3/4 of a full year maximum payout. Now, that's a risk because in an 08 or even a mild recession, that's going to slow down, right? So maybe it gets cut in half. Okay, so maybe it drops from 14%, down to, or 15% down to 8 or something like that. But then you also have dividend or distribution reinvestments. Typical, I know the case of Cliffwater and others, it's, in my experience, it's over 50%. So if you're paying out, right now, let's round it to 10, you're getting distributions of 2.5% a quarter. That means you're getting 1.25 every quarter, right? Or call it 5% or so a year. That's on top of your, right? So that's, and then you can have new cash flows. One of the things that really bothered me in the press is the article Bloomberg just wrote about Cliffwater. They talked about the 7% redemption and 14% requests. The 7% redemptions was not the net cash flow in the fund. It's what they chose to redeem. The fund was still receiving positive net inflows, of some significant amount during the month. And the interviewers knew it, I'm sure. I can't imagine that wasn't discussed. And yet they don't report on it because it doesn't fit their narrative. They want to create a panic so that people tune in and read their articles. It's not an unbiased. The job of the media is not to inform. It's to create noise and get people to pay attention.
So I must say, Matt, I learned something in this episode. And one of the things I learned is when there are redemptions, like in these interval funds, there are a bunch of levers they can pull. And so I not to say that you still can't have the collapse people talk about and everything, but I mean, when there's redemptions, they can go to cash. They can use the cash they have because all of these places have some degree of cash to handle redemptions. They have lines of credit in place. They're receiving payments and interest from the things in their portfolio. Some of the loans are paying off over time. So I just thought it was a more nuanced take on versus like this whole thing is going to fall apart. Everybody's going to sell in mass and they're not going to be able to cover the redemptions. Like actually thinking about the levers they have to pull if there are redemptions was really interesting to me.
Nuance is like the theme of the episode here, right? And it's the theme of excess returns in general. If you want to get smarter, if you want to educate yourself, all you're going to find out is all I know is that I don't know nothing. It's just nuance on nuance and nuance and nuance all the way down. This is like we're at the point with private credit where people say it and it's like, you might as well just say like bonds are bad. It's like, okay, which bonds are bad? Are they really all bad? Which bonds are bad? And it's like, well, credit's bad. Okay, which credit? Which part of credit's bad? Well, private credit's bad. Okay, at the end of the day, private credit's still bonds. It's still lenders, still borrowers and lenders. In any statement or any view, you have to think about the mechanism between borrowers and lenders. I can go to the credit union down the street. I can ask them about their lending practices to which borrowers. What Larry does a beautiful job here of doing is basically like articulating, and right or wrong, just like we were talking about in the last clip, like right or wrong, this is about thinking through the process. How do you think about different lenders and what their borrowers look like and what the spread is, especially when there's investors or there's liquidity involved on the other way around? Inside of private credit right now, there are a plethora of no good, very bad, awful, like actors and portfolios with lots of problems around them. But inside of that, just like in the financial crisis, a lot of banks lasted to the other side. A lot of bonds didn't ultimately default. They got reworked or they got paid, or like the economy normalized in some way, shape, or form. We came out the other end. This level of manager due diligence with this awareness of both what could somebody get through, like I hate to say it, it still feels early for this, but this is the kind of stuff that creates opportunities too, which is where you want to be educated on the nuance in the process and listen to somebody like Larry so that you don't just hear the purely doomer take.
Yeah, to your point about what we're trying to do with excess returns, I can't wait until my like the YouTube thumbnail of like an incredibly balanced take on private credit starts working. But unfortunately, Matt, that's not what that's not going to happen.
It's never coming. It's never coming.
So as we head into our next clip, this is something I'm asking a lot of people about, because this whole world of abundance, Matt, I want this thing that the tech people are telling me I'm going to get from AI, and so I'm trying to find somebody to give me the problem with it is like someone like Bob is going to look at the actual economic steps that have to happen for you to get this thing. And so like often that means I'm not going to get the thing. But anyway, here's Bob talking about this idea, because we talk about AI is going to make us more money. It's going to make our lives better. Here's Bob talking about the idea of the difference between productivity and consumer surplus.
Well, I think actually productivity, it's very important when you're thinking about technology to not confuse consumer surplus with productivity. And people confuse this stuff all the time. So a very simple example, the fact that I can connect with, my high school friends on Facebook is consumer surplus, right? It makes me happier, right? Similarly, the fact that I can, ask questions about the 1947 World Series to ChatGPT and get an interesting, quick response also improves my quality of life. But it does not make me any richer. Does not make me any richer. Productivity, in order to have productivity gains, you have to be wealthier, meaning you have to make money per hour work. And there's a big difference between those two things. And so as an example, like people kind of think of, let's say, the transition to mobile or social media, things like that, as being productivity enhancing. No, they're consumer surplus enhancing. But actually what's going on is the same old thing that's happening in the economy that has happened for a long time, which is there's advertisers. Those advertisers are advertising to you where your eyeballs are. And that's basically it. You know what I mean? Like Facebook is the local newspaper of, 2015, right? And similarly, we might have ads and, spending or something in ChatGPT, and that would be the same thing as newspapers from before. Maybe it's a little more efficient, et cetera, but basically a lot of the perceived benefit in the day-to-day is consumer surplus. Very simply, if you're not making more money using the technology, you are not being more productive. You may feel better, you may be happier, you may feel more enriched, but unless you are making more money, you are not more.
This is a question I ask myself all the time, because I'm making like better YouTube thumbnails and YouTube video titles and stuff. I'm like, hey, is that really
right?
changing?
And the question is, right? That's you might perceive it as being better, but like literally, is your YouTube revenue going up as a function of doing? I think the answer is probably not. I mean, I have nothing against the show. I'm just saying.
Well, the problem is here too, is everybody else is also making better YouTube thumbnails than is my YouTube revenue actually going up?
Right. Such a good example, right? You're all doing it, and you're basically, and there's consumer surplus in the sense of like the thumbnails look better, and it feels easier to engage with as a consumer or something like that, or they're just prettier. I guess YouTube thumbnails aren't really pretty, but you get the point. But the question, it just comes down to, is there more money being made or not? And I think that is such a critical component, because I hear all sorts of people talking about, oh, I'm so much more productive. I can create more reports. I can do this. I can do that. I'm like, are you making more money? And they're like, not really. Okay. If you're not making more money, you're not more productive.
So what he was telling me about the YouTube thumbnails is like the perfect example of this. Is like, you and I are doing all kinds of stuff on a daily basis that's making our lives way better, more efficient. But are we making more money with AI? And that's a really interesting question. Like, and I think, and the YouTube thumbnails is really interesting from the perspective of like, yes, can I make a better YouTube thumbnail? Does it make me more money? Maybe, because I might, like, more people might watch the episodes, so I might do that. But also everybody else is using AI in their YouTube thumbnails. So do I actually do any better? And even if I do, like, isn't somebody else doing worse now because they're not using it in the YouTube thumbnail? So is there really anything created? So, like, unfortunately, when Bob makes me think about this, I'm like, all this positive stuff I'm getting from AI, when I take it back to like, am I making more money? It becomes more challenging.
It's a troubling thing. This is one of, I think, the really important lessons to draw from anytime you study, aggregation or aggregate economics. And you think about, how does this stuff ultimately end up? I think about this with YouTube a lot, where I'm looking at the stuff and I'm like, how are they doing this so well? How is this one getting so much attention and whatever else? And then you don't see all the things that aren't. Like, you don't see that difference. You're just looking at where you are in the average. And unfortunately, or for better or for worse, what the algorithm is telling you, here's where we should misplace your attention to try to like keep you here and solving this puzzle longer. The reality is, though, like, that bar, I feel like, keeps coming up. So we might not be making any more money in aggregate. It's going to be interesting when we drag this bar up as high as we're probably going to drag it with these tools over the next, 1, 3, 5 years, whatever it's going to be. There will be money-making opportunities inside of this, or some of the stuff that doesn't make money for a while, all of a sudden makes money for a brief period of time, or whatever it looks like. And I think you need both of these terms in your head so that you can understand when something clicks into gear. But you can also understand stuff that doesn't hurt you, like how all the positive like network effects and other things we've seen by doing these shows.
Yeah, you've got to think about the interplay with all of it. And that's what really Bob brings in, is when you think about income and you think about it's got to be generating more income, that's really important. So for instance, let's say I could make more money on the YouTube thumbnails because let's say I was paying someone before to make the YouTube thumbnails and now it does it for me. Now I'm making more money, but guess who's making less money? The person I was paying to make the YouTube thumbnails. And so that's the problem, is when you carry this across a whole economy, you can't just like be like, all right, we're going to fire everyone and therefore we're all going to make more money and we're going to have this world of abundance, because the problem is all these people who are fired aren't spending money. And so that's the lesson from Bob, is like, we got to think about all the different steps that go into this. It's not that it's impossible to do that. It's just, it's much more challenging because of that fact.
Much more challenging because you can't just have winner take all, right? I know we're going to get into some of this in some of the other clips, but that's where this goes.
So we're back to the 100-year thinkers again. And this was one of the reasons I was excited for you to talk to them about base rates, is the idea that they really are the opposite of base rates in many ways. Like, they're trying to find the companies that defy the base rates. So here's them talking about base rates and outliers.
Yeah, when Mobison wrote the base rates paper, Chris, I don't know how you interpret it. I think he was cautioning people that you ought to be looking at base rates, because to diverge away from base rates is very rare. Well, I should say, to diverge away from base rates over the long term, to do something quite differently than your base rate that's going to endure and sustain, is really highly unusual. And so you really need to sharpen your pencil or sharpen your thinking when you have a company that has moved past its base rate, because it's so rare. It doesn't happen that often. Now, I would suspect that Bessenminder's report, if we looked at those 46 companies, pretty much every one of them probably diverged from base rate over time, because that's the source of the excess return. But Michael was just saying it's so very rare. So start with the base rate. And then if you have a strong conviction that they're going to do something other than the base rate, then you better be very, very good in making that assumption or calculation, whatever the case may be. So I think it was almost kind of a Graham thing, like, start with the base rate, and how is this thing, valued on its base rate? And if you're going to buy it because it's going to do something other than its base rate, you better be really thoughtful about that.
Yeah, I think it's not like it's an either or question. It's like base rates or this.
Yeah.
The base rates, to know that in the back of your head that the odds are against you in this particular business because you're betting on some outlier that's so you just know the odds are against you, but it doesn't mean that you're not going to do it. So that's part of what we do as portfolio managers. We want those extreme outcomes. That's why we have a portfolio.
Yeah.
So hopefully you have 20 names, 15 names, whatever it is. And so that gives you lots of shots at possibly getting one of these extreme outcomes.
So yeah, I might go to you for some insights on this. Like, it's just very interesting to me to think about like the proper way to use base rates, because on one hand, like base rates should inform what you're doing. But on the other hand, like people like Chris and Robert don't exist if they just listen to base rates all the time, because they would never invest in the types of companies they've invested in.
Yeah, I mean, take, for example, nicknaming conventions here, as evidenced by this episode. Would you have known or assumed in any lifetime that you could call Michael Mauboussin Moby?
Well, I would say one of my career goals now is to get the relationship with Michael Mauboussin where I can refer to him as Moby. I don't think it's going to happen for me, but I think that's like probably that's a very small inner circle that can probably do that.
I mean, because if you think about it, you got Moby, the acclaimed innovator, musician, and then we have another Moby in finance. Like that's 100-bagger right there. That's 200-baggers right there. 200 baggers for my money right there between the two Mobys. I look at this, and one of the most important things that I heard both Robert and Chris articulate in different ways across that whole episode, but it comes out in this clip a little bit, is this idea that base rates are descriptive, but as you change the reference class, as you change what you're looking at it and think, like they think in layers of these base rates. This is my words. This is like my takeaway from hearing them talk about it. They think in layers of these base rates. They're like, okay, here's the broad reference class of what stocks do with their return on invested capital or whatever else. And they think in that broad class. But then they step back and they're like, okay, well, I'm interested in this smaller subset now. And then of this smaller subset, I'm interested in this other smaller subset. And now we're getting back into my children's cereal analogy, I think, where it's like what toy do I really want? And well, that means I'm going with the Captain Crunch and I'm going to ignore those Boo Berries because this is the direction that I want to take this thing in. I want that toy that they're featuring. And they have this understanding of being like, okay, different base rates, different reference classes. Let's move up into the area where I'm the most interested based on my confidence, maybe not certainty, but availability of information, and go like, oh, I have a good feeling about how we're going to approach this. It's a different way to view the world. It's very nuanced. What do you think?
Yeah, and I think you have to look at base rates relative to your own conviction. And I think that's the best way to use them, is to say, like, the rarer it is in the base rates, the more conviction I have to have. So like Michael's recent paper is about OpenAI, and Kai Wu has an interview with him that's coming out soon on the channel. But the idea is like the growth that's implied in OpenAI has never happened before ever in any company. So that doesn't mean it won't happen, but it means you really have to have a very, very high level of conviction if you're buying OpenAI based on the fact that you think it's going to achieve that level. And I think that's the way to do it. And Robert and Chris have been on the right side of defying base rates for their whole career. So it doesn't mean it can't be done. It just means like I think I have to look at my level of conviction relative to them.
And I don't want to give it away because it's coming up in another clip that I know we're going to play in a minute. But they talk about this and they talk about when it changes. They give examples of the software stocks. They give examples of some of the other stuff. So before I push us into that one, I think we have Bob Elliott again. Do you want to preview this one before we hit?
Yeah, this one's important because I think right now on Twitter, everybody in the world thinks they have an edge on predicting the Iran crisis or oil prices or whatever it is they're trying to predict. So here's Bob talking about recognizing you don't have an edge.
No, it's such a good question. I think the most important thing when you're thinking about analyzing an environment like this is recognizing that you don't have a clue what's likely to happen from a policy perspective, right? That's good. That's a good place to start. You have no idea. And I will tell you, I have no idea. Certainly no edge relative to the market in understanding the mind of the fella at Mar-a-Lago. Okay, so given that, and given that those efforts, those policy shifts are creating a lot of volatility, you basically, if you're targeting a 10% vol book, like your Sharpe ratio, for instance, is down by 50%. Let's just assume that your Sharpe ratio, meaning like if you have a great understanding of all the macro linkages of how everything's working, down 50%. Okay, well that means you should take a lot less risk than you would have taken in a different environment. And that's okay. That's part of being a good asset manager, is recognizing the variance in your conviction. This is a low conviction environment. And so you got to trade it that way. Like you don't really know exactly what's going on. And that's why, if we just tie back to what we were talking about earlier, why is there so much deleveraging from levered players? For this exact reason. Conviction has gone down in this environment. And that's step number one. Step number two is make sure you're betting on things that you can actually know and understand. So for instance, if I look at oil prices right now, I don't have much of a strong view. Why? Like from a macro perspective, I don't know, taking 8 million barrels off, it should be something like 100 to 120. The price is basically 100 to 120. I don't really have much conviction beyond that. I certainly don't have much forward conviction on exactly how all this stuff's going to play out. What you can have more conviction on, and I think the thing that markets in general provide in terms of medium-term alpha from a macro perspective, is those market linkages. And so if I go and look at what's priced into the bond market, well, the one-year inflation rate, the one-year inflation swap is mostly reasonable. Maybe it could be a bit higher, but I'm not, but who's really gonna tweak that? But then you look at, maybe we're in a more elevated inflation environment, or maybe we should have more risk premium in bonds given what's going on. Those are things that you could look at and you could say, and those are probably not reflecting it. Or I think one of the more interesting things is look at what's going on with stocks versus bonds right now. Stocks versus bonds from a macro person's perspective is a really good indication of forward growth expectations. Stocks have actually gone up relative to long-term bonds since the Iranian war began. Okay, well, that's odd. You have a huge oil shock going on in the economy and a huge erosion of real spending power, and you're telling me that growth expectations are actually better today than they were on March 1st. That's what's priced into the market. Those are the sorts of things like, do I know the growth is going to fall to 2 or 1 or 0 or -1? I don't really know, but I know that the skew of that trade, even if oil prices normalize tomorrow, is mispricing the likely economic hit as a result of what's already occurred. And so those are the sorts of things you have to look at, is really look cross asset, really look macro fundamental, and at the same time, be really humble about what you could know, because basically, Washington has eroded a lot of your Sharpe ratio.
So there were two layers of this for me, Matt. One is the fact that Bob recognizes that he has no idea what's going to happen with the Iran crisis. He has no idea what's going to happen with oil prices. So that was the first layer. The second layer is he's thinking about how this is being priced in the market and the relative pricing of different assets. And he's thinking that's where the opportunity is, because that's an opportunity that doesn't require him predicting the things he has no edge on.
I go back to the Hippocratic Oath with a lot of these things. And it's, first do no harm, and do no harm both to yourself, but also to others. And part of that is the intellectual humility to say this, I have no edge here. I need conviction in some of these areas. I need information to come up with that conviction in those areas. But my first stance should be first, don't screw anything up. Don't make anything worse by action. That's really hard for a lot of people, I think, to admit when it comes to their portfolio, when you're drinking from the fire hose of the news that we're all drinking from right now.
Yeah, no, it's really, really hard. And, I don't this has been humbling for me. I mean, it's humbling. I've never been a person who thinks I can predict any of this stuff, but it's humbling to take a look at this. And, I think as an investor, you also have to look at it from the perspective of the people that are telling you things that are going to happen right now. Like the 3 times leveraged Strait of Hormuz ETF that's probably going to launch very soon. I would imagine it's probably going to, if they can get it out before the whole thing gets, that may not be the best way to do this. It may be a more humble approach that looks at all the different potential outcomes might be a better one.
And so help me God, if we get a Strait of Hormuz coin or something like that, or a token.
Someone's got to be trying something, right? I mean, people if this stuff comes out, someone's going to try to profit from it. So I'm wondering, you probably can't launch an ETF to invest in things that would relate to the Strait of Hormuz and get it out in time, but something's coming. Yeah. It's probably already out there and you guys don't know about it.
Please don't put it on blockchain. Please don't introduce an ETF for this.
It's probably one of those cryptocurrencies that comment on every one of our episodes. I don't know if you see them. I try to delete them as quickly as I can.
Oh, I do.
But they rename the cryptocurrency every single time. So it's me swearing at my computer because I'm them and I are in a battle here. The thing gets renamed every single time. And I can't figure out how to block it without having to delete it. So I try to get in there to block the name of the cryptocurrency faster than they can put the thing up. I don't know who I'm battling with, Matt. I could be battling with bots. I don't think I'm battling with people probably. So it's a losing battle for me, I guess.
The amount of markets where we truly have no edge, including in the YouTube comments alone.
This is very true. So we're back for our 7th clip here. We're back to the 100-year thinkers again. And this is an interesting thing about base rates is base rates, when you have sort of these step function changes, base rates can change as well. So we have something with AI right now that you could argue maybe we can't use the past base rates as much as we could. So here's the 100-year thinkers talking about that.
The point about winner take all markets, I think that's, again, Robert says as a growth investor, I mean, that's kind of what you want. You're looking for those kind of situations. You like winner take all markets as long as you have the winner. And so that's a good dynamic to have. But AI, I don't know. I mean, I can see it going a lot of different ways. I certainly think there'll probably be an explosion of new businesses and new services, but once it settles down, I don't know. It may just revert to the same as like a lot of other businesses. Eventually, there'll be people who are really, really good at it, and we may get the same old as before.
Yeah. AI is definitely going to give you more competition. There's going to be more people nipping at your heels because of AI. The question is, can they make a business out of it? Can you take my business away? Are you doing it better than I'm doing it? Are you doing it cheaper than I'm doing it? In which case, some of my customers are going to leave and go somewhere else. So that's what we have, and that's what we want to look at in software. How many people are going to leave Salesforce to adapt or adopt a new customer retention, a new CRM model that's not Salesforce? And we've thought about it in the firm. We thought, well, okay, now we're not a big Fortune 5000 company. I don't expect that JP Morgan or anybody else is going to turn over their Salesforce CRM to a new entrant that doesn't have a track record. But if you're a little shop, you got 15 people, 20 people, and they've got a new database that can help you manage your customer relationships, and it costs 10% of what Salesforce does, which is very expensive. Would you give it a shot? And the answer is you probably would. Now, does it work? Is it better? We'll find out. But there's going to be tons of competition because of AI. The number of winners, though, I think, Chris, will be probably the same. There'll be few. There'll be, a few that will capture the best part of it. And there'll probably be 97% that are going to go to the dustbin. So
that's kind of what I think. And you said it better than I did, but that is, and it makes me think too. Remember, the internet's the same way. When the internet first came along, of course, there's an explosion of .coms, but now it's a fairly mature thing. I think we could say, there's a handful of kind of dominant .com businesses or retailers or things, and it's not. So I don't know. I think AI will probably have a similar trajectory.
So what was your take on this? Because I know you were live in the interview here. I'll throw it to you to get your take on this one.
Something that my brain always goes back to when we're talking about this, and we talk about the winner's curse, or you talk about there's whenever you're in a race and it's a competitive situation, one of the inevitable outcomes or problems is, well, what happens if you win? And the classic example, like in financial services or any place where there's a cost cutting thing, it's if you're in a race to zero, the worst thing that can happen is you win. And now all of a sudden you've raced and cutting your fees to zero or whatever it's going to be. And once you're at zero, there's nowhere else to go. And the competition is gone. And you're stuck as the person who said, like, I can do this for zero. Likewise, in the opposite direction, and I worry about this with the AI stuff, it's like, well, is the top Skynet? Is the top Cylons? And I'm living in Battlestar Galactica? Like, what happens when there's one of these companies to rule them all? Or how's this? So step functions across these races are really, really interesting to think about it. On top of that, when you start to see like a pack break away, the Peloton, we get in that, not the company, like Tour de France terms that I halfway understand from every now and then when I watch it. Like when you break away and you get these people that are in this pack, you do have to reassess what they are. It was fascinating in this conversation, in this piece, where it's like, you start to think about, what do you do from companies once they get into that space, and you have to assign a new set of base rates to them as this new reference class and what you're going to compare them to historically. Because we see those changes too. It's a real skill set to switch between these different reference classes.
Yeah, that's the challenge with like going back to Michael Mobuson's OpenAI thing. Like that's the challenge with AI right now is we don't even know what the base rates are for this. Like it's a step function technology based on what we've seen in the past. And so it's hard to say, like, as much as me as a value investor is like, there's no chance. Like reading Michael's paper, I'm like, there's no chance OpenAI is achieving these levels of growth. But like, I can't say it's definitely not going to happen. I mean, we're in a completely different world than we were in before.
Yeah. the world changes and it changes fast. And sometimes the base rate, the set of data that you were operating on, you were like, oh my God, I can't believe these margins are here. I can't believe that this is the new future. If that book gets thrown out, the best thing you can do is step back and go, this book just got thrown out.
And by the way, to your earlier point, I do worry about where we're going with AI here. Like I was thinking the other day, because we were talking to somebody, we interviewed Anthony Wong from T. Rowe Price, which is coming out next week, on this idea of like robotics. And I was like, oh, it's going to be great when like the robot can mow my lawn. It's going to do the dishes and stuff. But then I was thinking like, what if the robot decides that, you know what, if I stab this guy to death at night, I don't have to mow the lawn anymore or something like that. It's like, that seems like the next logical thing, right? For these logical thinking things. So I'm like, maybe I don't want the robot anymore.
You saw the dancing robot in like the Chinese restaurant or in the,
I saw like the first lady walked out with a robot the other day or something, right? It was like on the news.
Yeah, I missed
Yeah,
that.
there was something on Twitter, which by the way could have been fake as well. I mean, she may have never walked out with the robot. Who knows? Like, we're getting into a world now where we're not going to even know. We're going to be talking about stuff on this as if it happened, and we're going to be like, we don't know if this is real or not.
I want to transition us to another clip from 100-Year Thinkers, because in those changes, Chris and Robert both got into this idea of how do you handicap something new. So we're talking about software and terminal values. Let's roll that clip.
Let's say you're an investor in a software company and you've had this long track record, maybe a 20-year track record of success, and now AI comes along and the market is basically saying, throw out that, that base rate in the last 20 years track record or whatever it is, because this new technology has now changed the landscape completely. So that makes it a little tougher. If you flip it around as the AI investor, the guy who's investing in the AI natives, and say, okay, well, this is new technology, throw out the base rates because this is going to be the next best thing. Yeah, you're on the other side of the table. But I think both of them they're not easy to handicap in general.
Yeah.
Every innovation.
I think Chris. Yeah, I think Chris is spot on. When we had the damage done to the software space, we had sold those. Many of the software companies sold all our software companies except for Microsoft. Back 2024, only because I couldn't figure out what the new base rate was going to be with AI in the software companies, right? I mean, if you think about the sell-off in software, it really was a debate about the terminal value. So when you run the DDMs, 80% of the value of your DDM is in year 11 on out to perpetuity. 20% of the value is that, if you're running a two-stage 10-year model, 20% of the value is that 10-year stream of cash. But, Bessenminder would tell you, that the residual value was what created those 46 companies, right? So I think the market struggled with what's going to be the residual value. And that's based upon what's the future base rate, right? What are these things actually going to grow? Now, are they still going to be around? Yes. I think, that's the argument. But the question is, nobody has an idea exactly what's going to be your revenue, what's going to be your revenue base rate growth from here, because AI is going to take part of it. But you might have other opportunities that you can jump in that can offset that. We just don't know. And when the market can't figure that out, that's when you're going to get these big swings in prices. Now, I find it very, very interesting. Everybody wants to jump back into the oversold, what they perceive to be the oversold price of the software companies. And I get, here's reversion to the mean and Ben Graham and all that. I get that. But they still haven't answered the question, what is the residual? What's the base rate of this thing going forward? Nobody knows because of AI. So that's a tricky bet to make. A reversion to the mean bet is a trade. A reversion to the mean bet that you want to hold long term is that you've got a firm handle on what that residual growth rate will be. And for me, Chris, I struggle with trying to figure out, what's Salesforce going to look like 5 years from now? What's ServiceNow going to look like 5 years from now? I can't get that into my mind, and so therefore we don't play that game.
This is funny because I'm always like one of these people that when the stock goes down, 60%, I'm always like, that's got to be a value. Like the stock can't be going down 60%. But I think the way Robert praised this is really important. Like this idea of when you do a DCF, and I don't do DCFs because I'm a quant guy, but like how much the terminal value actually matters. So sometimes you think like this is the market irrationally responding to this thing, but if it actually is something that impacts the terminal value of this company a lot, then the market should, like some of these stocks probably should be down 60%.
I love this idea of you should have I'm somewhat imposing my own words onto this just to be abundantly clear. You should have a 5-year view on this company and what's going on. I think this is a very reasonable thing to basically have. Like in the next 5 years, here's basically the direction of revenue, earnings, margins, whatever else. Here's my understanding of where this is going in 5 years. And the reason that that's probably extra important, and it goes back to the Wes Grayism that I always love to quote, or at least where I'm stealing it from, is from Wes. And that's, momentum is an underreaction to good news. Value is an overreaction to bad news. And it's only a good value. It only got cheap on that 60% decline. If you have that 5-year outlook in mind, you have that model, and you're like, oh, this got cheaper than the expectations of what should happen over this 5-year period. And there will be cases with the 60% decline where all of a sudden you go, I don't know how to think about this over 5 years anymore. And then you just need to tap out. Robert's saying that about a bunch of the software stocks, about some of the other things. Like, I don't know how to think about this anymore. So I need to remove myself from this calculation. That's a really powerful statement for concentrated value or growth investors.
Yeah, it made me think about the Buffett too hard pile, but it's kind of the same idea. Like that's very hard to do, by the way, because there's a lot of all of us that are in the investing industry, we have some degree of egos and stuff. And so it's very hard to step aside and be like, what's going on right now? I can't analyze this. I'm going to put this aside. I'm going to focus on the stuff I know how to analyze.
It's very tempting. Our egos are very, very delicate creatures, especially in this industry, especially when largely we're in the practice of helping other people to understand and be comfortable with stomaching risk for saved assets that they know shouldn't just be in a coffee can in their backyard or, tucked away in a savings account. So it's like, if you're going to put risk on, you need people to help you think about taking those risks. If you're in the position where you're helping others take those risks, you have to have a certain amount of confidence in the way you communicate these things. And even still, you can't know everything. So you have to.
By the way, I was saying this terminal value thing works both ways as well. Like the value investors like me who are like, Amazon is so expensive. Like we weren't thinking about the terminal value of Amazon on the other side of the equation. Like Amazon was worth way, way, way more because of this value that existed in the future that other people saw that I didn't.
Exactly that, because you're reminding me of, and what this clip reminded me of was the DA wallet conversation. Because to the hard cigar butt only value investor, it's like you're not understanding the optionality inside some of these spots.
And that's why, by the way, I have tons of respect for people like DA, because think about that. I mean, he's valuing things that have no revenue, that have the potential to be something, and he's looking at this terminal value and he's figuring it out. So that's the most extreme example of how hard this can be.
Yeah. So if you like this clip, if this resonates with you, take the 100-Year Thinkers episode and pair it against that DA Wallach interview, because understanding the DCF, understanding a short period of time, what those step changes might look like, and then pricing the optionality on each is enormously, I think, useful for both understanding, having the humility, but also thinking through the technical rigor to get some of this stuff right.
So for the last clip, we're going to stay in software again. And this is another interesting one from Larry Swedroe, and it gets to this idea of nuance. But, the narrative out there right now is software was a business that private credit has a massive amount of exposure to. And so therefore, now that AI is going to disrupt software, this is a even bigger problem for private credit than we already had. So I asked Larry about that.
It certainly is an issue. It should be talked about, but the press sadly is again one-sided and talking only about the bad and the worst case scenarios, this SaaS apocalypse, or I call it SaaS catastrophe, whatever. You have to differentiate between products that are, easily replicated by AI, a single thing that's doing some calculation or something like that, and an embedded software that's an enterprise-wide product, right? And some of the products that you may lend to could be disrupted easily by AI, and others are embedded software that integrates many different products, would take months, if not years, for you to replace, retrain your people, and the AI tools that you're talking about disrupting, you can use and you have time to implement to improve your system so they work better. Those embedded software tools, I think, are probably at very minimal risks, and they may even benefit from them, okay? And therefore, you want to look at, one, how much concentration do you have in software in general? Okay, in Cliffwater's case, I believe it's like 21% or something, which is typical of the industry, all right? But Cliffwater, I would say this in my discussions with them, they've been underwriting for disruption risk in AI for years. This has been talked about, and they made the decision to avoid businesses or minimize risks to businesses they thought could be at a higher risk of disruption and focus on more of this, what you might call embedded software. Now, they can make mistakes and be wrong, but again, they'll be highly diversified. They take a few hits. It's not going to blow up the fund and cause massive losses. And from what my conversations with them, they've done webinars to explain to the advisor community. They just did one the other day. They believe their risks are relatively low. That's where they've concentrated. And so you want to underwrite each individual firm to see how much of their portfolio is concentrated, and within that, how much is really at risk to technological disruption, or how much might even benefit. Now, let me add this. All these other industries that they lend to, right? The history of innovation is it's, in the end, it's not the innovators themselves, it's the users who often are the biggest beneficiaries. So all these other companies, let's say a trucking company that they lend to, okay? Well, now they've got better systems that enable them to be much more efficient in the use of the trucks and drivers and manufacturing. And, you know, you've got supply systems and, you know, you're manufacturing like a Walmart, right? How much they store and stock of each good, and supply chains can be better managed. The profit margins of those companies could go way up, greatly reducing their risk. The media never talks about any of that stuff. I don't know why, right? There's two sides to this AI disruption thing. Yes, there are clearly risks. It's part of the story. It's a risk you take in any industry, but it's not limited to private credit. It's there for public equities, and it's there for public credit who lends to these companies as well.
So yeah, I think this is just another example of like thinking about nuance. Because if you think about it at a high level, like what is a business? And it's interesting because it's the opposite of me as an equity investor. So as an equity investor, I didn't like these software stocks because I'm by nature a value guy, and they're expensive, and they should be expensive. But from the perspective of debt, like these were the ultimate recurring revenue businesses. Like these are the things you wanted to own the debt of, because it's just, you know, that people aren't going to cancel these things. So you would understand why private credit would have a lot of exposure to it. But to Larry's point, it's not like every private credit firm out there is like invested 100% in software and this is going to bring down the whole system. It's very much on a case-by-case basis. And also to Larry's point, like not every software business is going to fail. Some of them might, but a lot of the other ones are probably still fine in a world of AI or might even benefit from AI.
We talked about it earlier. You can't talk about bonds without talking about borrowers and lenders. And when you're talking about borrowers and lenders, you got to think about pools. You got to think about how those pools are structured. You got to think about the incentives and all the layers. And yeah, there's probably going to be a whole bunch of problems in software and recurring revenue businesses. There's going to be problems in data center buildouts and some of these other places where you've moved from capital light to capital intensive industries. This is friggin' hard. Lending money is a business, and it's credit because there's like a risk premium built into these loans and default rates. We're going to find out how right or how wrong some of those default rates were through this part of the boom bust cycle, because it happens every time. That's why credit moves in cycles. This is why Ray Dalio writes books every so many years, reminding us of the ever-growing, longer, richer history of these cycles. But we're going to find out what those default rates are and where this stuff sits, and it's probably not going to be 100% defaults. So there's something in here where the risk is earned, and that's, to me, that's what's so interesting about trying to think through this part of this cycle.
It's always interesting to think about like what are the companies that are referred to as safe in the market and how does that progress over time? Like we had a guest a long time ago who talked about like energy companies used to be like the safe companies to invest in like decades ago. Then you think about like software. Software was like, this is an unbreakable business. You can't touch this thing. Or even the Mag 7 right now. Like, you know, the Mag 7 are like businesses, you know, they're like not utilities. They're like, you know, staples basically. You can't break them. And it's just interesting that like when you take a longer term time frame, a lot of times these companies that are considered the safe companies that can't be beat don't end up being that.
Yeah. Markets are rough. The more that gets priced in, I always can't remember who said this. Might have been like, it's such an obvious thing, but I needed somebody to say it to make it obvious to me. Might have even been Josh Brown a long time ago. Where it was basically like, if you just keep taking the risk out of something, if you just keep assuming safer and safer and safer, you bid stocks all the way up to the point where they basically are a treasury bond. Like the earnings yield and the PE basically match up, and you basically get the risk-free rate for the equity. And that's insane, and you should never take that because the risk is always there in your common stock. But the idea that you bid stuff up and we get stuck on these narratives, we get stuck on this information until some new reality upsets the apple cart, that's markets and cycles, baby.
Well, hopefully people have found this valuable. Next week, I'm going to have a surprise guest host because Matt is going on to one of his periods where he'll be out of connectivity. I think I got to send a carrier pigeon or something if I want to get in touch with Matt next week. So we will have a surprise guest host. We're going to have clips from Michael Mauboussin. We're going to have some other clips. So hopefully people will join us for that.
Join for that. If nothing else, you don't have to listen to me. And if you need to, send me a raven. I'll accept smoke signals. Let's see, what else could I do? If you can set up an elaborate mechanism of mirrors so when the sun gets to a certain spot in the sky, where it's...
By the way, I wish I would do this. Like, you're very good about doing this. Like, I need to do this sometimes where I'm like, get rid of all the devices. I don't want to hear from you. Like, I'm just going to be gone for a while. Like, you do a really good job of this. You're like one of the few people I know who can do it.
And I'm not doing it as well as I wish I could. But at the same time, I think it's really important in this hyper plugged in existence that we all have. If you don't give yourself a brain or a chance for your brain to just do whatever, like I've got an ever growing stack of books behind me on the floor because I have to figure out how many I can fit into the suitcase for this sojourn. But I'm like, there won't be a screen. The only thing I'll have near me is a window for about a week. And that's the way I like to do it.
Well, since you won't be here next week, I'll let you take us out then.
All right, you're watching Excess Returns. That's Jack Forehand. I'm Matt Zeigler. Make sure you see us on Substack. You want to get these posts, get all this good information into your brain too. Like, comment, subscribe, all the things below, and we are out.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.